Mike, I think what we should do now is do a sequential analysis of what's been going on in the markets, the steroids that have been given to the market in the form of liquidity, and start with the European Central Bank, because I said earlier that I saw some pictures of Mario Draghi and he looks terribly pleased with himself. And if there's an article here that I can just briefly read to you. It says ECB President Mario Draghi, embracing policies dismissed by his predecessor, is forcing Euro bears to capitulate since July the 26th, and that's when it really started. Draghi said he would do whatever it takes to save the 17-nation euro. The currency has appreciated versus each of its 16 major counterparts. So we may have missed the boat on the euro itself, certainly versus the US dollar, but maybe there's somewhere else we can look. Maybe we should look at bonds. We've missed the boat a little bit on equities, but maybe there's more to go. What do you think?
Yeah, it's very interesting that the market is terribly excited whenever good news happens, but the old adage of the tin being kicked down the street still worries us intensely. I think on a comparative basis, the euro strengthening, it always depends on the base from which it's strengthening, and it's been hammered. There's still a lot of trouble out there, and it's not just at national sort of debt levels, it's at banks, it's probably at provincial levels, whatever they call those, cantons, etc. It's also at towns and the like. So the issue really is that whilst the currency has rallied a bit, there's certainly opportunity within some of the bond issues, and even within equities. There's some quality companies in Europe and some quality bonds in Europe that in fact don't have the majority of their exposure or risk in Europe. So you can enter a global sort of franchise but through a European portal, and I think that's probably where the greatest opportunity lies right now.
So when you talk about investing in European debt, you're not talking about, for example, investing in Spanish 10-year bonds or Portuguese 3-year bonds. You're talking about corporate bond issuance and bonds that are a little bit safer.
Yeah, one of the best sort of known brands out of there from a global defensive perspective is probably Nestle. And if you looked at that company as an organization, it's massively defensive. So people, no matter what the circumstance, will have products that Nestle produce. Maybe less of the high-end chocolate, but certainly no less coffee or their hot chocolate. And if you look at that group, its earnings are derived not out of the troubled European economies. They're certainly a component, but they're a global play, and that's where I think the opportunity lies. There's a second opportunity, and that is that if we've been looking, and quite a few of the big investment houses in South Africa have been looking closely at South African issued debt in dollar and sterling, more so than euro, but in dollar and sterling there's some significant yields of 5.5%, 6%, and some upwards of 8%, where we understand the credit. Perhaps the Europeans and the global players don't, and yet you can get those sort of returns in hard currencies on companies that we're quite happy to invest our money in here. So those opportunities exist as well.
So again, you're talking about corporate bond issuance, and my point to you would be in South Africa that there are so many people chasing that. Whenever I speak to a company that has a bond fund, they say, well, yeah, we like South African corporate debt, well-run companies and good yields, but there just doesn't seem to be enough paper to go around.
That's true, and I think that could also create a little bit of foam and flutter and yield sort of compression. So one has to be careful of that. But I think that it's not just South African. We happen to know those banks and those corporates, and we understand the strength of their balance sheets. So the point I make is that those balance sheets are strong. They're probably going to resist the woes of the current economic crisis, which we don't think are done and dusted now that Mr. Draghi is smiling broadly. There are lots of issues to be dealt with, and if one just casts one's mind back to Japan in the early 90s, that's taken 20 plus years. It has not resolved itself yet.
No, and it doesn't look as though it's going to resolve itself in the near future as well, especially with the demographics of Japan. But that's another story. You talk about Mr. Draghi smiling broadly. I've never seen Ben Bernanke smile. And I wonder if he's going to stop smiling if inflation starts to pick up. The CPI data on Friday for the United States suggested maybe there's a hint of it. And with all the liquidity and with the economy threatening at some point to bounce back, perhaps that this massive bond rally that we've had in the United States Treasuries is finally going to come to an end with the threat of inflation and maybe no more interest rate cuts and maybe no more easing. Is that a possibility?
That's a great possibility, and it's a great risk. He's now on record as having said that interest rates are staying low and flat, and kind of zero interest rate policy will persist until sometime in 2015. Now, that has some seriously positive implications because it gives the borrower confidence. The investors are suffering, and as those investors convert their cash with lower and lower and lower nominal yields into government treasuries and longer term debt, if inflation was to raise its head, and it might suit the American government to do that, because if you can inflate the economy, deflate your currency, you pay back less dollars when you have to pay back Chinese borrowers or borrowers from Europe or elsewhere in the globe. But the investor gets less and less, and if they're convinced to swap into bonds and the bond yields firm, as we all know, there's a capital risk there. So you could be getting 2% on bonds as opposed to the 0.5% after tax in cash, but you could also be taking a risk of 5, 10 or 20% of your capital.
We also have to talk about South African government bonds, and we've spoken about the corporate bond market, and you like that, and I agree with you, and so do a lot of other people. Where I'm slightly worried now is the government bond market. We've got an MPC decision on Thursday afternoon from Jill Marcus and her team. It looks as though it'll be a flat line, and maybe not the last time that she's cut this year. We may get another one or early in 2013. But I just noticed with the political implications of what's happening in the platinum complex, and also with Cosatu and also with Mangaung at the end of the year, that there's just a hint of a bit of money coming out of the South African bond market. It's had a lovely run. Do you think there's a risk there too?
Yeah, that is such a difficult question because that market is highly liquid. South Africa probably is a proxy for some of the less liquid emerging economies. They've had a hang of a run as the globe has searched for yield. Just look at our property and listed property sector. It continues to steam ahead after having had an unbelievable year and decade, in fact. So, there's a lot of compression because hot money's been after it. Is this a correction? Is the holiday over? I'm not sure it is. There seems still to be some legs left in it. And if there is an interest rate cut, I do agree with you, a flat line is logical. With the American the Fed saying this is going to go into 2015, it gives the central bank here some room to move, and that could be bullish for the capital markets in the short term.
Mike, we'll have to leave it there, but thanks so much for popping into the Johannesburg Power Lunch studio this afternoon. That's Mike Estment, who's the CEO of NFB.